Hi guys, hello and welcome to a fresh new episode of our Made for YouTube series where we talk about different aspects of investing via mutual funds and a lot of perhaps the lesser known things as well. So today we are going to focus on a particular type of funds. Now, broadly speaking, there are five types of, categories that are there in mutual funds, equity, debt, hybrid. They're solution oriented, like you can say retirement, children's schemes, etc. And then there are the others category, which includes all the passive products. Now, within the hybrid category, there are six types of schemes which are available depending on your risk appetite, right? So there is a conservative hybrid schemes, there is balanced or aggressive hybrid. Depending on your asset allocation to equity. There is dynamic asset allocation, or what used to be called the balanced advantage funds earlier on. There's multi-asset allocation, arbitrage funds, and equity savings schemes. So today we are going to be talking about dynamic asset allocation, or what we used to know earlier as the balanced advantage schemes, right? And joining me today, I have Anupam Tiwari, who's the equity fund manager at Axis Mutual Fund. And Anupam also manages the Axis Dynamic Equity Fund. So he's best placed to talk about this. Besides this, he also manages their small cap scheme and also the Equity Saver Fund. Hi, Anupam. Thanks very much for joining in. So first things first, of course, let's talk about the category itself, right? Now, within hybrid, there are six categories, right? So what is so special about dynamic asset allocation? How does it work?
Okay, great question. So essentially, why we have different products in mutual funds? Inherently, to great extent, everything revolves around risk. How you mitigate risk in a, let's say, for an investor in different products. That is why we designed it. The whole objective in dynamic is that the behavioral problem of investor to time the market. If you just analyze last 15-20 years, retail inflow into the market or in mutual funds, you will find that generally investors come when bull run has already run its reasonable course, and highest inflow is during the near about the peak, and almost in every bottom there is no inflow, and in certain cases, maximum cases, there is actually good outflow. So this is a behavioral problem for investor when he tries to time the market, and this results into suboptimal return and also higher risk profile. Now, this high risk profile, which is inherently the volatility of return in his portfolio, deters him to give an optimal allocation to equity. So basically, you have two problems. One, you don't make enough money or reasonable return. Two, in doing so, you increase risk in your portfolio, whatever you are trying to do. So the solution is a dynamic product, which is based on a set rules. So every MC, whoever launches a dynamic product, creates certain set of rules based on their understanding of how they want to position the product. We also have a certain algorithm. And broadly, what happens is that when market goes down, equity automatically increases. When market goes up, equity automatically decreases. And the extent and the quantum and the timing might be different for different products. But this is broadly the philosophies. This solves a basic problem for the investor, which is one, timing the market, two, removing volatility in his portfolio. Now, why this volatility is very, very important for investors? If you analyze a normal common investor, his biggest enemy is his response to volatility. And generally, it makes him very fearful, or in a bull run, it makes him very, very greedy, and hence, big chance of making a mistake in asset allocation, or let's say equity allocation part. So that is why, and the only best solution right now in terms of a very well-defined algorithm-driven, a systematic method to overcome this problem is basically a dynamic equity product.
Okay, so basically the product dynamically moves between equity and debt. And I like what you said, Anupam, that an investor's biggest enemy is, their response to volatility. I'm going to use it again later on. But first talk about, the fund itself. And I want to talk about your own fund because you have also changed the algorithm, as I understand it, between how this dynamism works, right? So what prompted this change? What is this change? And what advantage does it now bring?
Okay. So what happened is, so we have not changed the algorithm. So algorithm remains the same. It just, we have added one flexibility to execute this whole algorithm. And then the reason was the lockdown. Our theory is based on trailing P, volatility, and momentum of the market. Now, what happened during lockdown is that trailing P started giving a very, very erroneous number, because there was a significant one-time impact on earnings because of lockdown. Now, formula was, as we have submitted it to regulator, is that we cannot interfere anything. We have to just follow the way it gives its output. But when the input itself is erroneous, you cannot help it, right? So we went to regulator and said that, look, this is a big problem that we are facing. So we just want in flexibility in certain exceptional situation to manually intervene, and correct this, normalize the factors, if you can say so. So that is what we have done. So algorithm remains same. Our core philosophy, core ideology of giving a very, let's say, less volatile, reasonably risk averse product to investors. So that remains same. Algorithm remains same. We just have now got a ability to manually intervene when market conditions are not suitable for the factors to give a right output.
Okay, so basically what you're saying is that now the fund manager, which is you, has a discretion to look at other aspects for rebalancing when times are volatile and not just depend on the model, right?
No, we have to follow the model, but when we are realizing that the inputs of the model are not normal, they are getting a skewed result because of some abnormal situation, we can normalize the model.
Okay, fair enough. Okay, so now the model itself is 2-in-1, right, across the board, which is that there is equity and debt both, and the allocation to both changes as depending on the market condition. Has this 2-in-1 model proved to be superior to investing separately in equal proportions in debt and equity separate investments?
I would say yes, because there are two differences. One is that this is not a debt versus equity product. So, for example, what happens in a typical asset allocation strategy is that, let's say, today is the first day of your investment, or you are rebalancing as an investor your investment. So what you do, you try to forecast whether from here on I will make more money in equity or I will make more money in debt, and what is the volatility in both of these two returns or these two asset classes. And accordingly, you will assess your odds, that where I can go right, where I can go wrong. And then you divide the money. Right? Generally, in these dynamic products, we don't do anything like that. So we are not concerned that whether debt is going to give us more money, more return than equity or not. We are not answering this question, neither we are asking this question in our product. What we are saying and is that at this given point of time, given whatever factors we are following, let's say trailing P, volatility, momentum, etc., what is the most optimum level of equity that we should own? The residual is debt. It's a residual function. It's not an intended function. And debt is basically, for generally most of the people, is like, normal short-term or medium-term kind of debt where too much of risk is not involved. So this is what we are doing. Our whole focus is on equity. In my opinion, this is an equity product. It's not an asset allocation product. What we are optimizing is just how much equity you should own in a particular level of market or a particular time. Now, why this is better than doing this thought process at investor level or not? Point number one is that it's based on certain factors which are well defined. So it is not based on whims and fancies of anybody, including me as a fund manager. And for investor, it becomes very difficult, especially for a normal investor, to comprehend these things in a very disciplined manner, and that becomes a problem. Two, we can, given it's a single scheme, we can optimize it much faster as compared, let's say, investor can do. For example, our ideal time frame is 40-day rebalancing. An investor cannot do 40-day rebalancing. Secondly, it will have a lot of transaction cost. You will have exit load, you will have entry load, etc., etc. And then psychology plays a big role. let's say you have allocated two funds, debt and equity. When you want to rebalance, there is some amount of lesser return in equity. You have a different call on markets. You say, no, let's continue, keep on doing it, and we will rebalance it later. In our case, it's not like that. It's, written in stone. This is what you have to do. This is what you have to follow. So it is much more disciplined, much more scientific, and a better method to execute it.
Okay, fair enough.
And, just sorry to
go ahead.
There is a big advantage of tax. When you are doing a lot of transactions in mutual funds in a short term, let's say 3 months, 2 months, you have a different kind of tax treatment. Whereas in a single scheme, if you are doing it, you have a different, which is much more beneficial to you as in terms of tax treatment. So it benefits.
No, I never meant to suggest that investors would be rebalancing that often. I just meant to say that, I continue holding equity for the long term. I continue holding debt according to whatever my goals are and, my own plan that I have. But anyway, since the category focuses so much on the model, which is, the AI-driven decisions, what helps one scheme stand out from the other? I mean, shouldn't all schemes be equal, or is there, are there some models which are superior to others?
Okay, so yes, there are differences in models, and see, market is a multi-factor model. So I can have 3 factors, you can have 3 different factors, anybody else may have 3 different factors. In my opinion, and it might sound a little ridiculous, factors beyond the point doesn't matter. What matters is how you establish connection between your equity level and the factor. Right? So for example, to give you just a very layman type of example, let's say tomorrow you can establish a very good proven correlation between level of rains in India and market. It's a very good factor, provided it should be noise free. It should be a long-term factor which has worked, let's say 70-80% of the time. Correct? It's a wonderful factor. So factor beyond a point doesn't matter. However, whatever factor you take, it will not work 100% of the time. Nothing works in market all the time. So at certain point of time, my algorithm will fail. At a certain point of time, somebody else's algorithm will fail. And also how effective you are in terms of implementing it. How better it can, readjust, because market keeps on changing. So for example, we had a problem that during lockdown, we couldn't have a right factor input to our model. So the basic difference is how dynamic it is, actually how it is implemented. And of course, everybody will have a different factor and it will work at different point of time. I think investors should take a reasonably medium to long-term view to compare performance of various algorithms. In short term, there could be huge difference in performance.
Yeah, in fact, I was looking at the last 1 year performance and I noticed that, from October all the way to December, there were only outflows or, what it means, more redemptions than money that's coming in to this category. Jan onwards, there was a pickup. And then Feb, all the way to April, it's almost 2,000 crores a month. So is there a market condition under which this fund does well? I mean, I'm just trying to understand why this vagary.
Okay, this is basically, our human brain has a very big problem that it can only analyze things in relative terms. We are incapable of analyzing anything in absolute terms. It's a biological fact. So now the problem is when market is going through a frenzied bull market, when you are looking at very high returns in a very short period of time, relatively, because these funds are, most of these categories funds are conservative, so they underperform the index or they underperform a, let's say 100% equity portfolio. And hence people doesn't like them so much during that bull phase. And once market stabilizes, people generally tend to allocate more. Let's say market has become expensive, let's get into dynamic category because it will automatically readjust, etc., etc. So then people start looking at it, these categories again. I'm not sure whether this is the real logic or not, but this is what, at least in my personal experience interacting with advisors, investors, that is what I have felt.
No, it could very well be the reason. And, just as a note, I forgot to add it earlier. And for everybody who's watching, please note that this category comes under the very high risk category. So, you must consider your own risk factors before you look at jumping in. Anupam, the other thing is, does the size of the scheme matter in terms of performance? I mean, again, looking at the last 1 year return, sorry, I haven't looked. I mean, I should probably have looked at 3 or 5 years. But in just the last 1 year, the returns vary between 20% by the lowest performing fund and 65% by the highest performing fund. And, I could not find what was the factor that differentiated it, because some of them were very, very large fund, 40,000 crores. Some were very small funds. So what role does size play? I mean, does it give some sort of agility? Does it give some sort of advantage to a scheme?
I would not say so. I think this whole material difference in return is actually coming not just because of size, but because of your different level of equities in different market conditions. And you must also see the returns in context of a particular market situation. So let's say market falls tomorrow by 25%, a low equity fund will outperform. Whereas a high equity fund, which has outperformed big time in last 12 months, will start getting in a big underperformance zone. So what key differentiator has been in this last, let's say, 12 months of market performance, how much equity anybody had in his portfolio as compared to, let's say, others. On size, I think at least we are of a very small size. So for us, size is not a problem at all. And also it doesn't give you any big help in terms of size, because at the end of the day, every portfolio manager in this product has to follow a certain formula, a certain allocation system, and he cannot change that. So if everybody is following that, of course, it means that they are able to do it. Otherwise, everybody would have said that, okay, let's stop in flow, etc. Third thing is that these are predominantly large cap categories, and large caps are fairly liquid, and then you have futures, options, etc. to manage the allocation part. So I don't think as of now, at least for us, size is any problem per se.
Okay. I wanted to just understand that, when an investor is looking to therefore select a dynamic asset allocation plan. Now, obviously, we are not privy to the models that, different AMCs would be using. How do I, as an investor, judge? And, past returns, of course, that whole theory has been debunked of looking at past returns. So, I mean, for me as an investor, what do I look at?
Okay, so, you can see what you want to achieve by this product, whether you want to have the best return product or you want to have best risk adjusted product. So in that case, you can make a judgment. If you want best return product, at least I can say for my product that I manage in Axis Mutual Fund, is that we have never intended to create this product with the best return in mind. Though we want is something called least volatile, best possible return kind of thing. So it's risk adjusted return should be high. That is what we try to achieve, and that's how the algorithm works. Whole optimization of factors is dependent on that factor. That volatility should be least as compared to, let's say, any other product. So that's one thing. So you can look at that. And second thing is that you can simply, let's say, compare 3-year, 5-year performance. Generally, we also provide a detailed presentation on our algorithm. At least for us, it's available on the website. So you can see which factor, how does it work, how it is calculated. Most of the factors have values which are publicly available. So we don't create any factor of our own. It's fairly publicly available information. So that's also you can do, and you can check whether it looks appropriate or not for your intended investment objective.
Okay, and just one final question, Anupam, is if an investor is looking, I mean, would you say that this dynamic asset allocation or dynamic equity, as you call it, should it be the core of somebody's portfolio? And if that is the case, then which other kind of schemes would work best with it to optimize the portfolio?
It's very difficult to make a generalized statement, because see, why we have so many different products in mutual fund industry is because inherently not two investors are same. Their time horizons are different, their risk appetite is different, their cash flows pattern is different. So it has to be assessed at what should be core or not has to be assessed at investor level. Unfortunately, as a fund manager, I cannot tell and I cannot decide. I don't have any tool to say whether it should be your core or not. It has to be based on analysis of your own personal risk, return profile, and your cash flow profile.
Okay. Fair enough. Anupam, thank you so much for indulging us and explaining this category so beautifully. Thanks very much indeed. Okay, guys.
Thanks a lot.
Thanks, Anupam. Bye. Take care. So with that, we've come to the end of this week's episode on dynamic asset allocation funds. If you have any comments or any further questions, we'll be very happy to get them answered for you. I hope you enjoyed watching it. And if you have any topics that you'd like us to talk about or explain, do put them in the comment section below as well. Thanks very much for watching. Bye-bye. Take care.